Day trading is by far the most difficult way to make money in the markets. I know some of you don't want to hear that, and you can fight me in the comments, but the stats don't lie. And even professional ex-Wall Street traders, guys who have managed hundreds of millions of dollars at prop trading desks and hedge funds, you can find videos of them right here on YouTube saying the same thing. They can make a killing on any time frame except intraday. Here's what people don't get told when they start day trading. When you're trading on a 5-minute chart or a 1-minute chart, you're competing against high-frequency trading algorithms. These are computer programs engineered by some of the smartest technical minds on the planet, designed to scalp thousands of times per second with more buying power than you or I could dream of. So if day trading has ever felt like smashing your head against a brick wall, that's why. You've been baited into playing a game where the house has a massive structural advantage over you. Now look, I know people who are successful day traders. TSU's own Taylor O'Connor is hands down the most incredible day trader I've ever seen. But people like Taylor who consistently make money day trading are in the vast minority. We're talking less than 1 out of 100. Now, if that's you, then hey, more power to you. Keep doing you. But the chances are pretty good that you're in the other 99%. And if you are, the problem might not be your strategy or your discipline or your mindset or any of the other things that trading gurus love to blame. The problem might just be the time frame that you were told to trade on. In fact, the reason that day trading is so difficult to win at is exactly the reason why it's pushed so heavily to people who are just starting to look into the stock market. Because the infrastructure profits when you trade more, not when you trade better. Every time you enter and exit a trade, you're paying a spread, right? There's no commissions for stock trading anymore, but there are with options trading. But even if you're not trading options and you're just trading shares, you're still paying the spread. You're still paying fees. And if you're doing that 50 times a day, guess who that benefits? It's your broker, it's the market maker, it's the exchange. It's not you. And it goes deeper than just the brokers. The entire retail trading education industry is built on the same model. Alert services, chat rooms, Discord channels where someone types buy now and you scramble to get in before the move is over. Auto trade services where you literally hand your account performance over to some stranger. They're all designed to do the same thing, to keep you paying monthly to follow someone else's trades, right? You never learn how to fish. You just have a monthly subscription for fish. And I know this because I've lived it, right? I've done the exact same thing that most of you guys do. I've signed up for the alert services and the chat rooms, copying someone else's homework and hoping for the best. Sometimes it worked, but usually just enough to keep me paying for the next month's subscription. But I never understood why any of it worked. And the funny thing is, I would always keep one account where I followed whatever trading service I was subscribed to at the time, and then I'd have another account where I found all of my own trades. And I noticed that over time, my trades worked out better than those supposed gurus that I was following. So eventually I started asking myself, why am I paying to follow someone else's trades when my own trades are outperforming theirs? Once you realize that the entire industry is set up this way, you can't unsee it. Everyone is trying to get you hooked on their magical trading system, their black box indicator that only they know how it works, so that you'll keep paying their rent every month. All right. Enough doom and gloom. What can you actually do differently to break the cycle? Well, first of all, stop looking at 5-minute charts and start looking at daily charts. Start looking at things from a higher perspective. And I know that sounds boring. The lower time frames bring those quick wins that feel great, but they also bring lightning fast losses that end up draining your account over time. The daily chart forces you to slow down. You stop getting sucked into the constant churn of intraday squiggles and you start looking at the bigger picture. When you do that, the patterns become much clearer and easier to trade. There's a stat that Josh shared years ago that has lived rent-free in my head ever since. He said, if you bought the open and sold the close every single trading day, you'd basically break even over time, meaning that there's not a lot of intraday progress that gets made from market open to market close on aggregate. But if you did the opposite, if you bought the close of every day, you held overnight, and then you sold at the open the next morning, you'd actually end up making a ton of money. So what does that tell us? It means that holding overnight is a huge source of gains for the market. So holding overnight should not be a source of fear for traders. We know that the market goes up more than it goes down on average, but most new traders have been conditioned to think that holding overnight is super risky, which is the opposite of what the data actually shows. Now, there's a lifestyle angle to consider here too. Day traders have to be glued to their screens for their entire session, right? If you miss a setup that comes and goes in the blink of an eye, it's gone. You have to be there and ready. Swing setups, by contrast, are very forgiving. They last for a while, and you usually have multiple chances to get in at great levels. This is one of my favorite things about swing trading as a busy guy. Once I've identified a stock that I want to trade, I just set alerts at my levels and walk away. If my phone dings because a level's been hit, I pull up the app on my phone, I execute the trade, and I just go back to whatever I was doing. I'm not a slave to my trading screen. My money is working for me, not the other way around. And I see this with TSU students all the time. Once they break away from the day trading mentality that some marketer sold to them when they were brand new to this, their results start improving. Trading just gets easier. So I want to pull up a couple of trades I took recently so you can see what this looks like in practice. You'll notice that most of my swing trades are not ones that I sit in for months and months. Typically, I'm in and out within a couple of days. So these aren't long, drawn out trades where I'm waiting forever to put cash in my jeans. My goal is to get in at a great level, make a good return on my money using options, and get out so that I can put that money to work on the next great setup. And it starts with building a strong watch list. So I have this layout here on TradingView that shows me how every sector of the market is doing. And this makes it super easy to figure out what to trade. I just buy the stocks that are setting up at my levels in the sectors that are already going up. And if I want to play the bearish side, I'll go short stocks that are setting up in the sectors that are already going down. But I usually stick with the bullish side because it's easier since the market goes up on average and there are no extra points for taking more difficult trades. The only time I'm taking bearish trades nowadays is when the whole market is starting to sell off, which we're currently doing while I'm recording this, and if I don't want to be caught out with nothing but bullish trades on. But most of the time, I'm just buying high probability setups in the best sectors. So a great example of this was CVX. Now this stock had been on my watch list for most of this year because it's one of the biggest names in XLE, which, as we just saw, is one of the best sectors right now. So the stock is qualified, right? We've got nothing but green candles as far as the eye can see, going back to the beginning of this year. So all I'm waiting on is a pullback to one of my levels. And most recently, we got that right here on March 10th. So once I'm in a stock in a great sector at a great level, all I have to do is wait for the market to do its thing. So if we expand this here and we look at the volatility boxes to the right, the level that I'm looking for is I'm just looking for the stock to come down to this blue volatility box zone. So what we're looking at here is the 4-hour chart on the right and the daily chart on the left. And I just like to zoom into the 4-hour charts just to get a little bit closer picture of what the stock is doing intraday as it is pulling back to my levels, ideally. So when I see the stock pulling back to the blue volatility box zone here, that is where I want to buy. And then all I have to do is sit there and let the market do its thing over the next couple of days. And you can see exactly how that has worked out since then. So this was a more than $10 move here, which, if you know anything about options, means that you make an absolute killing. We're buying the bottom of this candle down here when it comes into this zone here around 186. So we're buying right around there and then holding on for this $10 move up into and through the purple zones to the upside there. That's our profit. Now, the important thing to take away here is that the stock showed up on my watch list because the sector it's in has been outperforming the broader market for a while. I didn't find it by scrolling Twitter or because someone in a chat room mentioned it. It showed up through a systematic filtering process that I run only once a week, which I could automate and I probably will eventually, but honestly, I just haven't gotten around to it yet. Now, same process here on RTX. So different stock, different sector, but same framework. The sector that RTX is in, XLI, has been outperforming the market like crazy this year. The stock pulls back to my buy zone right here and my alert triggers. So I enter the trade and then I just wait for the market to do the rest while I go work on other things. So again, if we pull up the volatility boxes for back here on around February 10th or so, that was this moment in time right here. So on February 9th, I'm looking at the stock. This is one that I already want to get into. It is traded back down into my ribbon, which is one of the areas that I look for a setup to take trades. And then on the 4-hour chart on the right here, we see that it's pulling back into the blue volatility box. So that was on the 9th, which was this candle right here. And then the next day we had another touch of that volatility box there right on the bottom. So if I don't have a full-size position yet, I could scale into the position by buying some there and then buying more when we touch the volatility box again. And then from there, once I have my positions locked and loaded at the bottom of that candle and the bottom of that candle, all I have to do, again, is just hold on and let the market do its thing as we make our way back to new highs. So the point here is that none of this required me to sit in front of my computer all day. I have a pre-made watch list for the week. I check my charts in the morning, set my alerts, and then go about my day. When a level hits, I execute the trade, either enter or exit, depending on the level, and that's it. So if this approach made sense to you and you want to see the full framework, how to find these stocks yourself, how to build a framework that tells you when to get in and get out with zero guesswork, and how to manage the whole trade from start to finish, I put together a free class that walks through everything. It's called the Swing Trading Mega Class, and it covers this entire system I just showed you from watch list to exit with live charts and real examples. The link is in the description. Now, it's not an alert service, right? I don't even want you blindly following all of my trades. I want to show you how to build your own system, and I'm happy to give you mine as a starting point if it helps you. Either way, like the video if you learned something new, and subscribe if you want to see more videos like this, and I'll see you in the next one.